All right, Michael, hey, it's so great to have you on my channel. You know, I've been following your channel now for several years, and I just love your cutting edge style, the way you go after people that, come at, there's a lot of gurus and stuff out there understanding about the mindset of building wealth. And I think, your mindset is exactly the same as mine. So thanks for coming on. Why don't you tell the audience a little bit about how you got started?
Well, first off, that's high praise, so I appreciate that warm introduction. If you folks don't know myself or one rental at a time, I built a real estate portfolio, one rental at a time, starting in 2001. So I've been doing this for 25 years now, and I never had any vision of financial freedom. Clint, my vision with that first property was just to get to 4. I thought I had nobody in my world, nobody in my family ever had a rental property. Nobody in my family ever had wealth. And I thought my job for my family, my wife Olivia, my daughter Teresa, was to get 4 rental properties, keep socking away my 401k, and then when I got to be 65, the rental properties would be paid off because I was starting at 31, they'd have 30-year mortgages, and bingo bango, I would have options at 65. So that was my grand vision. That was my big dream for rental properties. And, once you get in the game and you do the work and you get a buy box and you get focused, you get to play Monopoly. And, we only had 40 grand when we started. I had a job. My wife had a job. And we put 20K into the first one and 10K into the next 2. And we were broke again. But, when you understand the game, I went back and did a cash out refi and took that money and bought 2 more and took cash out of the second one and bought 1 more. And next thing you know, it's 2006. Again, we started in 2001. And I go to an event by a gentleman named Bruce Norris, who had an event called the California Crash. And that obviously caught my attention. My properties were in California. Also, I came to real estate after losing 80% of my wealth in the dot-com crisis. So I was already burned once by a crash. And, having become a millionaire again, I did not want to do that again. So I paid to go to this event, and I didn't understand half the things he was saying. But the one thing I took away was affordability index. And, I didn't really know what it meant, but I did some research, and I quickly found out that my chosen market of Fresno, California, had never been that much unaffordable. And because Bruce, had a track record of being right, I took massive action. I immediately started selling my houses, and we 1031'd into multifamily properties, which were on sale at the time. So 2006, we start selling. We sell our last one in early 2007, and we scoop what turned out to be a lot of fake equity. That first house we bought for 107, sold for 263. The next time it trades at 75.
Wow.
So 70% crash my market had. And, we were out of it. We were sitting in multifamily. So we went from 8 doors to 80 doors in about 9 months. And, then the Great Recession happened, and we start scooping up houses for cheaper and cheaper. So, we had a job. Both Olivia and I worked for a long time. She retired in 2016. I retired in 2018. And we just built a portfolio ourselves, no joint partners, no syndications, just one after another. We just kept recycling capital, right? People think that we had all this money. We didn't, right? We had 40K that we recycled over and over via cash out refis. We 1031 exchanged into 80 units, again, no capital. And then we just did a bunch of BRRRRs during the Great Recession, and we were doing one every 3 or 4 weeks, using hard money or private money and then putting on permanent financing. We just had a system going. So, yeah, that's who we are. And it was just one at a time, just focus on the next deal. And, soon enough, we had a portfolio of nearly 200 units, and, bingo, bango, we're retired.
Now, what somebody may hear, and I've heard you on other shows before, and this gets brought up, right? Hey, man, you bought at the right time. You said you had this equity, fake equity, you sold. I mean, you were timing the market there. And now in today's market, as you and I were discussing before the show, things have gotten a little more tight and it's a little more different. It's a different market now. To the listener or the viewer right now, what would you tell them about investing? I mean, has it really changed that much in your opinion?
So there's two things I would tell an investor today. First off, the blocking and tackling never changes. Get a buy box, get focused, learn average. That's where most investors go wrong, is they're all over the place, right? I want to invest in this state, in that state. I want to do this thing and that thing. So most investors just need to get laser focused. Get a buy box, set a criteria, produce 20 to 40 active listings, and just get boring and repetitive. So that's kind of step one. The second thing I would tell them, and I mean this is the first buyer's market in a decade. I mean, if you really want to step back about it, and I would ask any new investor this question, and I'll ask you now so I'll get your reaction. Clint, if you are an investor, which you are, do you want more or less competition?
Well, I would say less competition.
So would I. Clint, would you like more inventory or less inventory?
More inventory.
So would I. How about this third one? Would you want more motivated sellers or less motivated sellers?
More motivated sellers.
You know what? So would I. Congratulations, folks. You're 3 for 3 in 2026. More inventory, more motivated sellers, less competition. In fact, the only people that will win in 26 are investors, buy and hold investors. Why? Because we don't care about interest rates. We don't care about your list price. We only write great offers that work for us. And you, Mr. and Mrs. Seller, you can say no. But we will move on to the next one because I am looking for that one motivated seller that will take 20 or 25% off list price, who will give me a 20% seller carry at 0% for 3-year balloon payment, or whatever it is, whatever you want to do. This is the best buyer's market in a decade. So congratulations. It is not easy. It will take work. It will take repetition. But get off your ass and go get your great deals. That's what I would tell them today.
Well, you said two things there that I think is really important that people should have picked up on. The first one is about the buy box, right? Could you explain that in more detail for someone, what that actually means?
Yeah, the buy box it's an anchor of everything I teach because I see so many people not having one and they're just distracted, especially in the beginning, right? A new investor gets excited about real estate and they're all over the place. So I will give you my buy box from 2001, my exact buy box. Let's remember, I chose a market, Fresno, California, that I never lived in. I didn't know anybody. I had no experience in. It's just the numbers worked. That was the extent of it. And frankly, I could drive there versus fly. That was a criteria for me. So it was 2.5 hours away. But here we go. 93703. So one zip code in all of Central Valley of California. Single family homes. So no duplexes, quads, condos, trailer parks, nothing else. 3 or 4 bedrooms. So not the small, not the big. 1 story, 2-car garage, 3 2 or 4 2, so two baths, and between 1,200 and 2,000 square feet. That very specific criteria produced between 20 and 40 active listings. That was my requirement. If I was too restrictive and it was less than 20, I would remove something. And if the list was too long, I would add another requirement. But that's what worked for me in 2001. Why? Because I was a very busy tech executive who was on airplanes 3 times a week at least, and I had no time. That set of criteria allowed me to process my market every day for 3 years in a row. That is the only thing that I looked at for 3 years. Why? It does 2 things. One is that anything swam into that very small buy box, I would know faster than anybody else if that was a deal. And second, for new investors, I was distracted by nothing else. The rest of California might as well not existed. The rest of the asset types might as well not existed. Yes, I look at those things now, but I've been doing it for 25 years. For 3 years, I looked at that micro area, and I dominated. There's nobody that would have found a deal in that criteria faster than me because that's all I ever looked at. That's the key.
That's what I hope people get out of what you just said, because I was just at Brandon Turner's conference a couple of weeks ago. Actually, it was a week ago now. And I'm talking to investors, and they're new people getting started. And I said, well, what type of investing are you starting with? and they rattle off 3 different strategies. And you know what's going through my mind? The same thing what you're doing right now. You're just laughing, but I'm not laughing at them.
I know how that ends. I know.
Yeah, you know exactly how that ends.
Yeah.
And this is what's so important. By creating that buy box, what you said is you're no longer a raccoon. You're not getting distracted by the next shiny object that comes your way because you heard it on YouTube. Oh, this is going to be easier. Because you and I have talked about it. This is not easy. It takes a lot of work.
Yes, sir.
So the motivated seller thing that you're talking about. So you're discussing a strategy that many people have heard about before. It's called creative financing. Finding ways to put together deals without using conventional financing and the people that want to work with you. And I personally think, along with your line right now, that if you're in the right market, there are sellers out there that have seen those 5% CDs and the higher treasuries. They're starting to eat away. And now they're at 3.5%. You offer them something that's closer to what they were getting.
Yeah.
I don't know. What are you seeing?
No, again, I'll give you just real examples. So again, seller financing, is absolutely out there. It happens all the time. I've done dozens of them. Some people treat it like the holy grail. Like some sellers will just take a lower price because they want to be done with the headache. By all means, great. Go get a bank loan and get it for 70 cents on the dollar. It's just if you understand seller financing, you can sometimes offer more. I will give you the best example I have. Mm-hmm. So I bought a property from a guy who, again, these numbers are what they are, but they were 10 years ago. But it's just a real life example. He had a house that was worth, best case, $100,000. Best case. And for whatever reason, he would not take a penny less than $120,000. And I beat on this guy for 9 months. Every 3 weeks, I would follow up. And it never changed. So one day out of nowhere, I just said in almost frustration, I said, the only way I can pay you $120,000 is if you sell or finance. And his ears perked up. Yeah, I'll do that. I would like a payment. And I'm like, oh, shit. So long story short, I buy the property for $120,000. I put 10% down, so $12,000. And he gives me a 30-year fully amortized loan at 0% interest.
Wow.
And I know this guy because I've talked to him for almost a year. He golfed like every Monday or something with these guys. I guarantee you, Clint, he tells his friends every day, I got this Silicon Valley kid to buy my $100K house for $120,000. I'm sure he celebrates that story around the bar all the time. He just happens to forget to tell them that this silly Silicon Valley kid got a 30-year loan of $108,000 at 0% interest. He never tells them that part.
Yeah.
So again, seller financing is really possible. The other thing I'm doing today in 2026, because I've raised millions of dollars to go shopping, is when I find something I like, I'm generally writing 2 offers. I'm writing a completely disrespectful cash offer. I'm talking 35% below or more, depending on the asset. And then I'll write a creative second offer, depending on their equity position. If it's owned free and clear, maybe it's 100% seller financing. Most of the time, they just have 40 or 50% equity. So I'll have them hold back 20% or something. So again, when you understand it, you can play with the numbers. Because in my world, Clint, I'm just trying to buy and hold something forever. I'm not a wholesaler. I'm not a flipper. I do 1 or 2 deals a year. I just want them to be amazing deals. So I'm willing to write 100 offers. And, that's just, you do those enough time, the numbers are in your favor, and you follow up, a dozen times, and you'll get a few.
Yeah. Brings back a story when I remember I said in my fraternity about trying to find, girls at a party. You just hit on enough of them. Finally, one of them was going to say yes.
Exactly. Yeah.
Just keep trying. So the thing is that when you're writing those offers, okay, when you say you have the backup offer, so you got the cash offer and this one, do you submit those both at the same time or do you come back?
No, same time. That's just something I'm doing today because I'm trying to figure out because let's be honest, I write up such disrespectful first offers. I do not expect anybody to accept either one. Mm-hmm. But I do expect them to pick one and poke at it. And that tells me something about their motivation, right? If they're only talking price, they want to, some people want to be cashed out. It's a headache. It's an estate sale. Like they live on the East Coast, their dad, whatever. Others are like, oh, tell me more about this payment thing. Like, how am I secured? Am I protected? Like, what happens if you don't pay me? Right? So again, I'm trying to figure out where their motivation is and what might be more interesting. And then I just go deeper on that. So I'm using the multiple offers to check for motivation.
Now, there's certain things that you look for in the market in which I mean, you said your market, but for somebody else, because again, I'm just going to go back to the event that I was just at. I would ask people, where do you live? Oh, I live in Oregon. All right, where are you planning to invest? Oh, I'm going to invest in Oklahoma. I'm like, well, that's fine, but it seems to me that that is difficult because I invest out of state. And the only way it's worked for me is I have actually boots on the ground and I've been able to put deals together, but I can't imagine how more difficult it is if you don't have that. So what do you say to those types of investors?
So I say a couple of things. So first and foremost, I believe real estate investing is a skill, so it can be learned by anybody. And again, if you're fresh at this, I would suggest you get a buy box, as we talked earlier, in your backyard. Why? Even though you live in Oregon and you will never buy in Oregon, the first thing you need to do is learn the skill of becoming a real estate investor. So get a buy box in Oregon, spend 90 days looking at it, go walk properties, talk to contractors, figure out taxes, figure out rents, insurance, all of that stuff in your backyard. And then when you have the skill, and what do I mean by that, is when you can articulate what an average deal is in your buy box to an uninterested party, you know how to do it. Because once you've learned that skill, it's rinse and repeat in other markets. So again, if I was this person living in Oregon wanting to invest in Oklahoma, I would spend 90 days in Oregon in my backyard learning the skill. Because that way when you go to Oklahoma, you already have the skill. It can be repeated, but now your job is to network and find boots on the ground and build the team. I would not want to do both things in Oklahoma. Right? I wouldn't want to learn the skill and build a team because it's not positive leverage. So that's what I would tell people and have told people.
Now I've never heard someone say it that way before, but I think that is so important because learning the skill, you don't have to find a deal, right?
Yeah, you don't.
No. It's like playing football, right? You start the season, we would start in the summertime, 2-a-days, and you practice for 2 months to learn the skill to go out and finally play your first game. And many times that was an away game. So this is what we're talking about here. You're learning the skill, and then you're taking that skill to the other market because otherwise, you're going to get chewed up there.
Yeah, you want to de-risk it. Out-of-state investing is risky. You know, Bigger Pockets often talks about the core 4. I don't think it's the core 4. It's got to be the number 5, and that is, do you have trusted boots on the ground? Now, here's my definition of trusted boots on the ground. A, you don't pay them, and B, will they show up at your funeral? That's my bar. Because again, if you have an aunt, an uncle, your roommate from college in another market, and that's your trusted boots on the ground, they're probably going to fly to your funeral. And why is that important? Because I want this person to tell me the truth. I don't want them to tell me the most rosy, pretty picture of shit on the ground. I want them to tell me the shit on the ground. Right? I want the truth. Yeah.
We all find that lesson out one way or another in our investor. I told you about my first property in Memphis. The second one was in Indianapolis, and actually about 3 properties there, and I wasn't getting paid any rents. Well, it turned out every time I called in, the property manager, there's always some excuse. I actually flew out there. The guy had died, and his kids were running the properties. There were tenants in the property. I went to the properties. I was like, this is supposed to be vacant. Who the hell are you? I thought it was a squatter. Oh, I pay rent. I've been here for 4 or 5 months.
I pay so-and-so, yeah.
They were taking the rents.
Of course.
Yeah, they were stealing from me.
Yeah, I've had PMs steal from me. Never, It happens. Be careful. Yeah.
All right, so what about other strategies then? Okay, so you get your buy box, and you're talking about working with sellers. Are there other things that you see in this particular market now? If you were starting over, so would you do the exact same thing, or would you do something different here?
Again, one rental at a time is nothing but boring and consistent. That's kind of my trademark. If I was starting today, it would be the same strategy. It would be just learn the market, figure out what the average is. And here's the key about average. That is when the work is done. But I don't want anybody ever to do an average deal. The whole idea of an average deal is any monkey can do it. Yeah. I only want to do good or great deals. So what does that mean? So let's say average is a yield of 6.5%, just making a number up. I wouldn't want to do anything less than 8.5 or 9, and preferably 10. Why? Because again, I don't want to be average. I can only do 1 deal a year, Clint. Why would I want to do an average deal? So again, I would just keep swinging the axe, and that's what I'm known for, is just keep swinging the axe. And eventually, like you said earlier in college, right? You ask enough ladies, and eventually someone says yes. And And if you can do amazing deals every year for 5 years, pretty easy to start this wealth wheel. So that's what I think. I wouldn't overcomplicate it by sub 2 or any of these other strategies that add layers of risks. I'm just a W-2 guy that worked 60 or 70 hours a week, had a family responsibility, and tried to build wealth on the side. I wouldn't overcomplicate it.
Well, you brought that strategy up, so I'm going to ask you. So, what do you think about Pace Morby? I mean, you run into a lot of his people.
So
and they're all out there
yeah.
sub 2. Yeah.
So first and foremost, I would call myself a friend of Pace Morby's.
Mm-hmm.
He just spoke at my event last year.
Okay.
He gave me probably the most important advice I've received in the last 3 years, and that is to know thyself. When I was struggling with comparison syndrome and all this other nonsense that you go through in life. And so, again, I would call him a friend. Sub 2 works. There is no question. There is a right way and a wrong way. I'm hearing about some things in that community where some investor built a portfolio of 30 or so doors and is now losing them all, which puts 30 or so sellers who thought they were free of this into the crosshairs. So there's obviously risk in this. I've never done one. I have no intentions of doing one, but it is a strategy that works. Again, if you know it well enough. So that's what I think.
Got it. Well, so, like you said, you got to pick your strategy and then practice and get to know it. The thing that I see a lot is that, or maybe it's just natural human instinct, is that people want to buy properties to say they own properties. You get that sense that because
I think it's even one step further than that.
Really?
So again, I think a lot of people look at real estate as their get rich scheme.
Mm-hmm.
Unfortunately, they're looking for strategies that get rich quick with no money. So they are attracted to the BRRRR, the sub 2, the Airbnb rental arbitrage, or what all these other things that seemingly don't take money. And dude, if you are in real estate, you need money. Breaks, taxes happen, insurance happens. I think there are too many people that are trying to do this with no money. And that's the downside of this, I think.
So what would you tell them? Where are they going to get the money to put the deals together?
I can only, so here's the deal. I think getting wealthy is 3 steps. Step 1, you have to create discretionary or disposable income. And I say this as somebody who started with 0 disposable income. I was a married man. My daughter was 6 or 7. We had no money at the end of the month. I was just like every other American. And when I finally realized that we were going to do this, we audited our expenses. We did a need versus want. And we cut out all the wants for 15 years. And we ultimately cut our expenses to 50% of our income. So, life's about choices. Choose your heart. And we chose a season of sacrifice and created disposable income. That disposable income became assets, and those assets grew, and now we're wealthy. The second thing you could do is you could increase your income. You could get a side hustle. You could change jobs. You could get commission-based, whatever. Or you can do both. So if you're in this situation and you have no money at the end of the month, suck up, buttercup. Own your choices and get after it. I mean, I can only tell you what I did, and I did 12 or 13 years of sacrifice. There's no easy answer. Choose your heart.
It's refreshing to hear that because a lot of people, we'll probably get some comments on this video. People will say, "Oh, you don't know my life and how difficult it is," and I don't. But I do know this in talking to people, that there are a lot of things like you stated, needs versus wants. And people don't understand. I remember when Tracy and I were struggling, I was trying to grow a business. We used to go to this restaurant called the Olive Garden, and we'd get a salad and share the salad.
Endless breadsticks.
100%, you've done that.
I have.
Yeah, only the person that has done that had to make that type of sacrifice,
Absolutely.
Understands that mindset. And so many people now they want it all. They want the big screen TVs, the iPhones. They fly off the shelves. I have enough money to buy a $1,000 iPhone every year, but I can't afford to make my mortgage payment or my car payment. It's a strange...
Extreme ownership. We are missing ownership. You are an adult, and you are living the life that you choose to live.
Yep.
Sorry. Make better choices.
Okay, so You moved into then from single family, now you've gone into multifamily. And of course, you just don't jump right into multifamily. You have to start and work your way up. And so you said create that buy box, and that buy box obviously is going to be single family properties. But then when does that transition take place? Or how do you, would you tell someone as you're going through this, when you start looking to move in?
So again, I don't think everybody has to. I mean, I've been asked, and I'll answer it here, like, what's your ideal portfolio? Like, what I would tell somebody today, like, if I had a portfolio and I passed on what I want my daughter to give, that's the portfolio I'm thinking about now. I want 20 single-family homes that are younger than 5 years old. That's what I would want to leave her. And let's be clear, Clint, I own 0 of those today. So I might be, over the next decade, 1031ing into new construction because that's what I want to leave her ultimately. So I don't think you have to go to multifamily, but why did I? I did that because Bruce Norris Event said there was going to be a California crash, and I had lost 80% of my wealth in stocks. I had 200 grand that turned into 40. That's not fun. And I did not want to do it again. I had no intention of owning apartments. I didn't even know people like me could own apartments. But I knew I didn't want to suffer a loss. And I just had blind faith and action because I'd done the work and studied affordability, and I knew Fresno was in trouble. People say that I called it. Kind of. I thought Fresno would have a 10 or 15 or 20% haircut. I had no idea Norris Drive would sell for $263 and then trade for $75. I had no idea it would fall 70%. No idea. I'm glad I sold, clearly. But yeah, I had no intention of multifamily, but why'd I sell? Because I wanted to avoid a collapse.
Well, I think something you mentioned there about your daughter and leaving her the 5-year properties. And this is, I think, an issue for a lot of real estate investors, and I am guilty of this. Because when I grew up, my dad, we would buy properties, he'd buy homes and rehab them, and to some extent light rehab, fix them up, and then we just always maintain them because he was his own property manager. My father's 81 years old, and he's been rehabbing another rental. A tree fell through the roof, and he's been on the project now for 8 months, fixing it up. And my mom wants him to sell the whole portfolio that they have because he's always doing this.
Yeah.
So I grew up with that mindset. And back in 2018, we started investing in Winston-Salem, Houston, and Oklahoma. The Houston and Oklahoma portfolios that I bought, they were fully rehabbed properties, less than 15 years old. I paid more for them, so my returns on those properties were going to be lower, right? But the ones I was picking up in Winston-Salem, I told you earlier, I could buy a house for $15,000. And I thought, oh, wow, I'm going to put this in, and boom, boom, boom. And to this day, I regret that decision because I have to put so much CapEx back into Winston-Salem. But here's one thing that I didn't realize if I had to redo this, is that when I was buying those properties in Houston, when you buy it and it looks great on the outside, I didn't think, what's under the ground. And so we had a number of sewer lines because tree roots have gone in there and broken them. And those, because they're on slab, those are not inexpensive fixes. That's $15,000 out the door.
Been there.
Yeah. But I think that's something for the real estate investor to understand as well, that when you said 5 years or younger, what you're saying is, yeah, you may not get the return that you're looking for right now. Maybe it is a 6 cap property, 5 cap, but you're not going to have the problems on the cap.
I just think it's important that real estate investors go through seasons. Let's be and I mean this, I do think that's the ideal portfolio when you're done. I own 0 of them today. I'm trying to make that very clear because they didn't hit my minimums, they didn't hit my average, but you know what? I'm in a pretty good spot now. I could 1031 out of equity positions into something else, and they would cash flow just fine. And again, for me at this point, it's about making it easy for my daughter, not maximizing my cash flow. It's just a different season of life.
Yeah, well, I always think, investing out of state, that the one thing that has got me is that, if I was local, like you said, where I could drive to the properties, it would be easier to stay on top of that stuff because even though I have great property managers, they're still not going to manage your portfolio like you're going to manage.
No, of course not. Yeah.
And that's where my income sometimes too much of it gets sucked up into. But
Yeah, absolutely.
So tell me about one rental at a time. You know, what is, you set that up and you've got a great community. I follow your community. Tell me what the intention was behind it, and for the person that's watching, why they might want to consider that.
Yeah, one rental at a time is an interesting story. I remember coming up with that title around my kitchen table one weekend when I was contemplating getting a job. So to kind of tell the story, I retired in February of 18. I spent a couple of days excited because I'm 45, right? I retired at 45. But what happened when you're a W-2 employee and you're the best at it is you don't, or at least I didn't realize, my ego was wrapped up in my job. And I quickly became depressed. And I started feeling like a loser, frankly, because I didn't have a mission. So ultimately, one rental at a time became that new mission that I could do a couple of things a day on and feel like I'm positively contributing to the world. It became a book, a channel, you know, a community. But the mission since day one, and if you go back and watch the first video on my channel, it's me in a purple polo on my couch, basically saying, don't know where this is going, but my vision is to create something that outlives me by 50 years. Because I believe you die twice. Once when your physical body goes, and then the second time when the last person says your name. So I thought it would be really cool to take on a mission of trying to create something bigger than myself. And, you know, creating wealthy families is one way to do that. So I'm trying to create something that outlives me by 50 years, and that is one rental at a time.
Nice. So the people that are watching, if they want to get involved, I mean, it's a couple of Starbucks. That's all it is to become part of your community, right?
Yeah. Yeah, I mean, well, the first thing that I would tell you is don't even waste your money yet. I post roughly 3 videos a day, 7 days a week. So just watch me on YouTube. Figure out if I gel with you. Figure out if my community works with you. And then if you like that and you want to be around other wealth builders, yeah, you could join school. It's $20 a month, 67 pennies a day. But, you know, again, I'm not doing this for the money. The reason it's $20 is because I don't want the pretenders.
Yeah.
Right? If I wanted to make money, it'd be $99 a month. I'm just doing it high enough to keep the deadbeats away, and so that is an option. But start on YouTube. YouTube's free.
Perfect. I know you do turn out an amazing amount of content. I don't know how you have the time to do it.
It's 3 hours a day, 5 days a week. That's what it is.
Yeah, well, that's great. Well, Michael, thank you for coming on. I really appreciate it. I know the people that are watching this are going to get a ton out of it. And guys, go to his channel. I'll have it in the show notes below. There'll be a link there. Subscribe to his channel. You're going to be completely impressed, just the way I am, the amount of information you're going to pull out of that. And Michael, you want to leave him with anything else?
No, I guess the last thing I would say is getting wealthy is 3 steps. Create disposable income, become an elite investor, and then the last step, do it for a decade. If you do that, your chances of getting wealthy are pretty good. So get after it.
All right, man. Thank you for coming on.
Take care.